Hey everyone, it's Mitch Goldberg here. Welcome to my live stream. It's your live stream too. It's called Be the Boss of Your Money. Let me just bring in LinkedIn. LinkedIn, you are now part of the broadcast. We are just getting started here. I'm Mitch. You're watching Be the Boss of Your Money. This is the live stream to come to learn about personal finance, investing, stock market, bond market, all kinds of things, investing, you name it. I said that twice, but this is what it's about. It's about personal finance. It's about managing your debt, managing your assets. It is, simply put, a place to learn about money, about yourself, so you could learn from my mistakes and you could learn from mistakes of clients, of actual people, because I've been a financial advisor now for 31 years. I've seen a lot, and I want to share with you the benefit of the mistakes of others so that you could accelerate the time frame to your goals, so you could make less mistakes, take control of your money, and live a better life. That's what this is about. So let's put in my banner. Let's roll the intro. We're going to do a quick market update. That's what we do on Thursdays. We'll talk about some of the biggest news and why, I've been bulled up and why I remain bulled up. All right. And we'll take a look at who's out there. If you have any questions, definitely, please, I love hearing from you. Ask me in the comments. Words of wisdom are always appreciated. Words of encouragement are always appreciated. And if you're watching this in the replay, same for you. Questions in the comments, words of wisdom, words of encouragement. So let's roll the intro, and here we go. Hey, welcome. If you're just joining us now, this is Be the Boss of Your Money. It's a live stream show about personal finance. And listen, it's not always easy to make personal finance exciting, but it doesn't have to be exciting. Sometimes the best things in personal finance are the boring things, the things that take planning, the things that take time, the things that take patience. Your number one tool when it comes to personal finance, whether if it's managing your credit score, growing your assets, figuring out where the leaks are in your savings plan so that you could accelerate the time frame to your goals, figuring out when you should pare back risk because a goal is getting closer. These are all the things we talk about. So I'm Mitch Goldberg. You're watching Be the Boss of Your Money. I had a very nice conversation with a new prospect today, and tell me if this isn't familiar. Now, this might not be familiar with all of you, but if you're over, and look, I work with clients of all ages, but in this case, it's clients mid to late 50s, and the conversation was, we just got our last kid out of college, and now we just want to know where everything is. We have stuff all over the place. We have insurance policies. We have retirement plans. We've got IRAs, SEP IRAs. We've got stuff all over the place. We really don't even know what we have. We don't know if the advice we've ever been given was really helpful to us. We're finally able to put some money away for us. We've been putting money away, but we could really accelerate it. And we want to know, what do we have to do to at least maximize our opportunities? And the way I put it is to maximize their choices that they could make. Retirement, yes, they want to retire, but they also like working. They might not want to just completely hang up the cleats and retire, but at least work doing something that they enjoy, but with less stress. Okay. I mean, there's always stress. There could always be stress in your work, but it's one thing when there's stress because just the job is demanding. It's another thing to have financial stress just tugging away at you all the time. So that's what, we talked about today. And what should we invest in? And my answer to them is there is nothing safe that pays a good yield, and nothing that pays a good yield is safe. It's just the environment we're in, which is why baby boomers are loaded up to the gills in stocks. It's why people that would ordinarily be 60% stocks, 40% bonds and cash, or 80 or 90% stocks. They all think that they're going to be the one who gets out just in time before the big drop. Hey, maybe we won't have the big drop. Maybe we will. Maybe it's in a few years. Maybe it's next week. Look, I don't have a crystal ball, certainly not one that's any better than you. I have my base case scenario. But when it comes to determining a client's risk tolerance, take this for yourself. When it comes to determining risk tolerance, I let personal finance be the guide. So the closer you are to a financial goal, the lower your risk tolerance. If somebody is, let's say, 30 years old and they want to know about if they should invest now or wait, my answer is, why wait? Your financial goal of retirement, for example, is 30 plus years away, maybe more, probably more. So why bother trying to time that? Invest now, reinvest. Just because the market goes down and your investments drop in value, it's probably temporary, right? Markets recover. They always have. The idea is to have a portfolio that doesn't frighten you into selling everything every time the market goes down. If you're that kind of investor, you're going to turn 60 one day and you're going to look back and say, I can't believe all the stupid mistakes I made. Listen, we're all going to look back and say, I can't believe all the stupid mistakes that I've made. I mean, I do, right? And I'm not 60 yet, I'm low 50s. So take it from me. When it comes to risk tolerance, let your personal finance be the guide. Don't worry about the ups and downs when your goals are a long time away. Worry more about your ability to sock money away. Worry more about doing everything you can to maybe grieve your real estate taxes, get the best possible deal in a mortgage that you could get. Don't lose sleep over. Just do the best you can. Plug the gap. Subscriptions that you're no longer using, get rid of them. Personal finance things. Understand that if you want a certain, or if you have expectations of a certain investment return over the long term, you have to take a commensurate amount of investment risk over the long term. And if you can't handle the risk, then take less risk. I would rather you take less risk and go for lower returns over the long term than be somebody who goes for higher returns with higher risk, but bails out of the market every time the market goes down, because then you don't get back in until the market goes up, until you get the all clear sign. And then you just keep selling low and buying high and selling low. And, that kind of sucks when you do that. It doesn't work. Okay. So let's see who's out there. And, I appreciate everybody taking a look at this. I really do. And I appreciate everyone who's out there. The best comment of the day, I already know who it is. Nobody could beat this comment. Hi, Daddy. I love you. You're my hero. That's my little girl. I love you, sweetie. That is so awesome. Rick is out there. Rick, you've been around a lot. I really appreciate you dropping by. Silver. Yeah, silver. Okay. Tangible commercial real estate. All diversified places. Better tenants and leases. Invest in a nice commercial building in an ideal location and live in its penthouse. You know what? I like the way you think, Rick. I really do. So, I'm going to have guests coming up. I already have a guest lined up next Wednesday. His name is Charles Freeman. He's a certified financial analyst. He's a CFA. Super, super bright man. Puts out amazing content, just like the kind of content on LinkedIn. And it's just, you stop. It's like you stop the scroll, not just because you read his content and not just because you want to actually go through the comments and interact. You stop because he gets you to think. And I love the kind of content that gets you to stop what you're doing so you could think. I hope I give you that too, really. I really do. So let's take a look at the day's action. We'll do a quick share screen I didn't get to do my multi-camera angle stuff. So if you have any questions, I'll answer them like this. I'm looking into camera 2, and I'll just look at camera 3 just because, I think it's a cool angle. It gives you a little behind the scenes look. Okay. So let's take a look at screen 4. Boom. Put myself in the box up here. You see me? Hey, I'm up in the left-hand corner. Let me make my screen a little bigger so you could see it on your little smartphone. And if you're listening to this, by the way, you don't actually have to watch this to actually see it, to enjoy it, because I talk. So if you don't see what I'm talking about, I'll describe it anyway. Okay. So the Dow, after a solid quarter, last quarter, let's see, the Dow for the first quarter, and obviously for the year, was up 7.8%. S&P was up 5.8%. NASDAQ up 2.8%. Good Q1. Listen, we're all looking for reasons for the market to stop going up. I'll give you some reasons or some things to look for, but let's just take a look. The Dow up 171 today. NASDAQ up 233 points. And first time ever, the S&P is now trading above 4,000, up 1.18%. Just a basically good day overall. And I want to show you this. This is super significant. Okay. I've been talking for a long time, if you're a watcher of the show, that when the VIX goes under 20, we could see another leg up in the market. It went under 20 a few days ago. The market keeps going. It brings in quants. It brings in hedge funds. It sends an all clear signal for new money to come in. So 30 was the level we needed to see the VIX go under. Then 25, I was saying. And for a long time, 20. It took forever. For months, it wouldn't go below 20, the VIX. The VIX is a volatility index. It basically measures fear in the market. When the VIX goes up, it means sophisticated investors are paying more money to hedge their portfolios because they're nervous. The VIX is lower than 20. That's the magic number that I've been looking for. Doesn't mean complacency. I think we'd have to really get down to like 10 or 11, let's say 12 to start talking about an overly complacent market. But it's 17.33 and right on cue, the market's been going up. The transportation average has been going up. Okay, let's take a look at a few other things. The 10-year treasury, we had a really good number today on manufacturing. We're seeing the best manufacturing numbers we've seen, I think, since like 1985 or it's just incredibly strong manufacturing. I'm telling you, if you still don't believe that the economy is roaring right now, then your eyes are closed. Now, that might be insensitive. I realize that it's still tough to find a job and people are still looking for jobs, but they are coming back, even in the restaurants, hospitality, leisure. And if you look at the stocks, airline stocks, cruise lines, hotels, they've been ripping higher. But remarkably, the 10-year treasury yield backed off a little bit. And that's why the NASDAQ was the better performing of the 3 major indices. Bitcoin was about flattish, 58,800. So that's holding up okay. Ethereum, 1,900 continues to hold up. So the cryptos have been doing well. People thought maybe that they would back off because more money would go into stocks. I guess I beg to differ. Coinbase is going public, I think, next week. Probably one of the most profitable exchanges out there. It's included now in the NASDAQ, the NYSE. It's just an incredible company. And then let's take a look at some of the individual stocks. Yeah, I know we're looking at Boeing, but what I really want to look at, let me make this a little smaller. It's too big for my screen to really get into the things that I need to look at. Let's take a look at the sector ETFs. This is the most important thing to look at. By the way, if you're out there and you're watching this, well, if you're out there, you are out there watching this, give this a thumbs up, maybe a heart. Let me know you're out there. Okay, I would appreciate that. I'd love to see who's out there, and let me know where you're from in the comments. That's always a cool thing to do. Energy was up today. Technology was up today. Communications. When I say communications, you're probably thinking like AT&T and Verizon, but AT&T and Verizon are actually a small part of the communication sector. The big part is Facebook and Netflix. All right, Google. So communications, real estate up, financials up. So economically sensitive stocks have done well. Consumer staples, healthcare, and utilities were a little bit lower. And that just goes to show you that investors are investing with expectations of a strong economy. But I think you could drop those expectations because you don't need them. The economy's here. It's strong. That's been my base case the whole time. Well, I was wrong. I said we'd see a strong economy in the second half of the year. We're seeing it in the first half of the year. And now that we're in the second quarter, which is typically a good time for the economy, look, I know today's April 1st, so we're 1 month away from somebody saying, sell in May and go away, which the only good thing about that expression is there's a rhyme in it. It sounds kind of nice. It sounds cool, but it's not really useful. So don't go by it. And then they'll have somebody on TV who will say, this time, let me tell you why we really should sell in May and go away. Not everybody has such a good crystal ball, I guess. Okay, so Rick, look at 88. What you're saying? We'll see. I can't really push specific securities, especially cryptos, on the stream, but I do appreciate your chiming in, and you're welcome to reach out to me anytime you want to chat. Okay, Rick, and I appreciate you being out here, and I enjoy the banter. So I don't want you to think I'm ignoring your comments. It's just that I can't come out and say, yeah, let's take a look at this. Let's take a look at that. There are other content creators that can do that, but I am securities licensed. I'm a registered investment advisor representative. So I'm a little bit limited in terms of what I could do compared to the other personal finance content creators out there. And I sure as heck don't want to give up my career to become a full content creator because, just not what I'm going to do. I actually like being a financial advisor. I enjoy my clients. I enjoy the job. It's been a career. And it's changed a lot. So that really wraps up the week. The manufacturing, we need to just take a quick look at what's going on over there. Okay. Manufacturing boom brings in, the reason I have this is because I use CNBC Pro. Okay. Manufacturing expanded at the fastest rate since 1983. Okay. I said 85. So since 83, it's people worried about inflation. So let me show you the screen, what I'm looking at. Okay. See this? Manufacturing boom brings more signs that inflation is building rapidly. Fastest manufacturing expanded at its fastest pace since December of 83. And all things are a go. So we have to talk real quick about inflation. I see somebody with the heart. Who's got the Judy with the heart? You're getting a shout out. I don't have my shout out sound effects with me for the shout out. So just, that's my wife. Thank you. So let's talk about inflation. The thing that could unravel what we're seeing going on now, not for the economy necessarily, is a rise in inflation. For be the boss of your money, I focus a lot on the stock market, and that the stock market doesn't necessarily reflect the real economy. I mean, just look at the Great Recession, how from March of 2020, for the next 6 months or so, the economy was awful and the stock market soared. So if that doesn't tell you that there's a total disconnect between the stock market and the real economy, I don't know what does. The stock market is a measure of the performance of the largest cap companies whose stocks are components of the S&P 500. So that favors those big FANG M stocks we always talk about: Facebook, Amazon, Apple, Netflix, Google, Microsoft. And those stocks were ideally suited for the work from home, stay at home situation, for the shutdown, for the pandemic. So those stocks, they did very well. So now we're getting this rotation into industrial stocks, but those FANG M stocks, they're still holding up. They might not be doing a lot of the heavy lifting now, although lately, I don't know if you've noticed, but Facebook's stock has been doing really well. But the industrial stocks, hotel stocks, reopening stocks are doing very, very well. Banks are doing great. Energy's doing great. These are all reflective of a strong economy or expectations of a strong economy. But if we're focusing on the stock market and things in the economy get too good, then we get inflation. Now, the Federal Reserve, headed by Chairman Jerome Powell, has said that he's willing to let inflation go a little hot above their 2% target for a while without raising short-term interest rates. A lot of market participants don't believe him. They think that he's eventually going to be forced to raise short-term interest rates way sooner than 2024. If that's the case and that does come true, that's a pretty bearish view then for the market. Not because he raises rates one time, but if you start to see rates go up too quickly and the spread between short-term rates and long-term rates tightens, and you see the yield curve invert where short-term rates go above long-term rates, that's an inverted yield curve. It's a very bad sign for the economy, and stocks would react very poorly to that. And it would hurt banks also. It would hurt lending. If you hurt banks, you hurt lending. So that is the bearish scenario. So we already have major inflation in terms of lumber and copper and gasoline. Okay. But it would have to be longer lasting and in things that you buy every day. You know, if you spend $200 at Costco and now you have to spend like $220 to get the same amount of stuff, that's inflation, the kind of inflation that you feel. Okay. You know, if it costs you like $55 to fill up your gas tank on your car, that's the inflation I'm talking about. That's consumer inflation. And if we don't get consumer inflation, but we do have inflation in raw commodities and energy without seeing companies able to raise prices to us, to the consumers, then companies' profit margins start to get squeezed, and then companies' earnings go lower. They come in below expectations in earnings, and that could hurt the stock market. So there are a number of things that we have to watch out for, and this is why no matter how bulled up or excited that I get for the market, it's why I always hold back from becoming exuberant, because in 31 years, I've seen some pretty dramatic negative turnarounds in the stock market and the economy that have caught investors by surprise. And if I give up a little bit on the way up, I'm okay with that, because I believe you have to protect the downside a little bit too. That's my story. I'm sticking with it. Stacy is out there. Hey, Stacy, nice to see you. Thank you so much. I haven't seen you for a while. Good to see you. Thank you very much. I'm going to end this broadcast now. I will be back on Monday. I hope everyone has a wonderful weekend. Happy Easter. Enjoy. Hope you get nice weather. And I will see you very soon. Bye.